One of the things that happens, one of the economic results of rising standards of living and per capita income is countries' currencies should appreciate, and they should appreciate what we call in real terms, that is adjusted for relative price levels. Now there's a couple of economic rationales for this, one of which is simply that as economies develop, the relative demand for services increase relative to goods. They become a more service-oriented economy. That raises the relative price of services, which tend to be less tradable than goods, and that's an economic channel through which it raises their currency's value and causes a real appreciation. The issue with China is that China does manage its exchange rate, and in particular it manages its exchange rate relative to the US dollar, but it does float against other currencies. By managing it against the dollar, it's preventing what is really a natural appreciation that should come from a higher standard of living. Now, typically in recent years, per capita income in China is rising about 8% per year relative to our rise of 2% per year. That's a 6% differential in per capita income growth, which these economic regularities suggest its currency should appreciate about 3% per year. Well, from 2005 to 2010, it hasn't appreciated at all because they fixed the exchange rate. So that does cause it to be undervalued, and it makes it difficult for the United States exporters to compete against Chinese exporters.